Alright, looks like we're live. Welcome everybody to Live Valuation. I'm Midas Moriarty. Just give me one moment to check the stream settings a little bit. Alright, looks like everything is up and running. So today we're going to take a look at Ingles Markets, company we actually looked at not terribly long ago, 2/3 of a year back or so. And we did actually add it to our portfolio after we valued it last time, finding it to be of pretty significant expected returns with decent confidence in qualitative factors. It has performed pretty well since then, so there's that. Just it wasn't a huge position that we made in our portfolio, but it certainly has added to at least the positive side of our portfolio's performance since then. But anyway, so we're going to reevaluate again today because its 10K has come out, and like I said, we will definitely be prioritizing revaluing the companies in my portfolio in particular when their 10Ks come out, as well as whatever other major companies that we're a fan of the various business models of for whatever reason on our watch list. So we'll redo valuations as some 10Ks come in if it's companies of particular note to us. So Ingles Markets qualifies in that regard for us, so we're going to take a look at it. I already did a lot of the initial prep work on it and kind of put the share counts from the previous years into the new template. Like I said, I'm kind of copying over from the previous file like I did with the other new 10Ks we've done, since I kind of did some small updates to the template throughout the year. And then I already did all the segmentation. They're entirely a US operating company, pretty much entirely in the Southeast United States, grocery store chain, as well as gas stations attached to the grocery stores. But that shows off their segmentation here: grocery, non-foods, perishables. So they kind of separate the non-perishable groceries as well as non-foods and perishables. It's kind of a weird way to separate them out if you ask me, but they have kind of like 3 separate categories for their grocery operations, as well as gasoline and other. So you can see the distribution between that. Either way, we have an unlevered weighted beta of 0.69, so not very large amounts of sales, or not a very large amount of risk associated with the stock on low volatility in general sense. A very high level of sales relative to the capital invested, which you do see with retail business models quite a lot of a sales capital ratio of 4 with a net adjusted margin of 4%. So you do get a low margin as a result of having this high sales to capital ratio. So how that weighs into Ingles Markets, we'll see. You can kind of see it playing out in the numbers, at least in the 1 year I already pumped in, which they had 3.23 for sales to capital ratio for this most recent year of 2021, with an adjusted net margin of 5%. So they're lower on the sales to capital ratio, but higher slightly on the adjusted net margin. So we'll see how that plays out in the rest of the numbers as I input them in from the copied over financial statements. And as far as their listed debt, we already put that in. They have $638 million of debt after you include lease liabilities, at a weighted average interest rate of 3.31%, and a weighted average maturity of 9 years. So pretty decent maturity, pretty decent interest rate. Could be better, but that's also not the worst. And that's on top of the market cap of 1.4 billion. So we'll see what that comes out to after the other numbers come in, but that's like 25-30% or whatever debt to equity ratio. So anyway, we will move on to the rest of the numbers as it work. Unfortunately, I don't have the earnings calls to listen to, so that's kind of why I have just some background music playing as I go. Okay. I do think Ingles Markets is like only one of 2 or 3 companies I've ever valued that have their financial statements strictly in dollars. As you can see here, it's not even in thousands, let alone millions, which is what I like to convert it to. So the conversion here with all the extra zeros looks kind of weird and funky, but that's because I still actually want to see the entire decimal. Even though I'm converting it into millions, I still want to see the entire decimal, just so that I can double check the addition. So it looks kind of crazy over here, but that's kind of what's going on. Oh, wait a minute. This is the retained earnings. Had that out of order there for a second. That corrects it. 1899, 1899, 29.8. Okay, so I guess that would be 30. What was their sales to capital ratio last year? Okay, so actually it was an increase in the sales to capital ratio. I couldn't remember what it was on the previous spreadsheet. I'm trying not to look at my previous spreadsheet from last year to not bias my inputs after the fact, but we'll see. So I had to look at it somewhat in order to transfer all the information over, but I tried not to really take note of what my assumptions were. So operating. So they have this netting out of disposal of assets in their SG&A for several years, which has been selling off the less profitable stores. So they're kind of not necessarily expanding, they're actually kind of shrinking in overall size, but they're also growing in profitability. So okay, so it doesn't look like they have extinguishment costs this time. All right, on to the cash flow statement. Depreciation. Gain and disposal of sale of assets. Oops. Very strict cash management. Oh gosh, baby. All right, now we have 3 years in. We'll at least take a brief look at their balance sheet, 3-year trend. I do believe that's a part of the reason that the stock is starting to appreciate rather significantly, and one of the reasons that it was depressed previously. There's a combination of reasons why it was trading at such a valuation. partially just because of the debt situation that it had, and it's definitely been paying off its debt over the last few years. And it's also its market cap's rising, so its debt to equity ratio has been dropping rather dramatically, as well as you can look at their current liabilities have been growing. However, their current assets have been growing at a slightly faster rate, so also their liquid cash positions increasing pretty significantly, including the literal cash positions. So that's made them a little bit easier for them to handle their position. Not to mention the type of debt that they have. They shifted it partially to lease liabilities, which has extended their duration a little bit longer, and also give them slightly better positions because of their small market cap size. They weren't necessarily able to get the best terms in the actual debt market. And then related to that, getting into their capital structure, they have the two classes of shares, with the parent class shares for that have the higher voting rights. I can't remember what the ratios. I think it's like 8-1 or maybe 10-1 voting rights for the alternative class of shares that are held by the family members of the original owners, the Ingles family and their other insiders, which converge upon any transfers or upon death or any other such special events. So essentially all of those shares are slowly being transferred over into the Class A shares, which is the shares that we're primarily looking at, and then those shares are starting to be repurchased as well. So as that happens, the control starts to shift more towards the public shareholder base, which is one of the other key reasons why the share prices have been so much valued. So as this happens, the company's market cap has been rising rather dramatically, and then you can actually see here on their PE that the PE itself has actually been coming down over this period, at least relative to this third year, because you can kind of see it technically ticked up between this year and that year, and also into the most recent period, which basically just shows that the earnings are also growing rather dramatically, though that partially has to do with the dynamics going on as a result of the most recent year of craziness in the market. So just quick little kind of comment on the trend in their company profitability, and you can also see that in the reported margin, this profitability has grown rather dramatically. It makes sense over, especially relative to 2019 to 2020, but it's nice to see that 2021 has also sustained that rather significantly. They haven't really been pushed down by inflationary pressures, but again, they also are working on their profitability at the core operating level of their base, of their business. So there is that. And then as you can see here, their effective cost of debt rolling is a little bit high relative to their book weighted debt, which was like 3 point something or other, but that's partially because we have all these included extinguishment costs. So anyway, those quick comments I just kind of wanted to make on their business model as well as their capital structure, and what that has to do with why the market is reacting the way it is now. Though obviously the climate surrounding these types of companies could shift as distance from the pandemic starts to grow, Omicron notwithstanding. So anyway, let's get back into these numbers, which I know is a little bit more boring, but Also nice, you can see that their returns on invested capital are going up pretty significantly, while also their returns on equity are scaling up with that. So that shows that the movement in their capital structure is been to the Class A shareholders' advantage. Hold on just one moment. Okay. Back to what we were doing. Oh, wait a minute. Okay. For a minute, I thought maybe I screwed up. When I was copying these numbers into the spreadsheet, the years was like getting offset from each other, and I only really corrected this top line of years into the correct spaces. So you can see like down here, it's kind of like weirdly offset from the correct spot. So I have to remember to kind of ignore these years when looking at things. Which, I mean, on that front, I guess I'm gonna double check, because I guess I don't remember actually noting this number, shareholder 595. $595, okay, cool. We're good, we're good, we're good. And I've just made so many mistakes like that and had to backtrack on the channel before, so go ahead and try to not make that mistake today. Okay, so on to 2017. Yeah, so you can see prior to the pandemic, their average net income margin was 1.89%, and so the current average net margin since the pandemic began at 4.44% is kind of extraordinary. And then if you just take the average of all 5 of those years, that's 2.91%. So you can see pretty significantly above that when you average including those numbers in. So no matter how you put it, the margins are pretty elevated right now, and that's kind of the argument, is where those margins can end up over the long run. You could argue that the stock is being priced like those margins are going to last forever, I don't necessarily think that's the case. Like I said, I haven't really looked back at my previous assumptions, but I'm pretty sure that I was projecting pretty much a drop in margins across the board, even in like the best case scenario. I think like the best case scenario was maybe like 4%, with like the worst case scenario being like 0.25%, if I recall, something like that. So that should put it like 2 to a little over 2% or something as an average or something like that. And I think I was still getting pretty great valuation overall, because I don't remember exactly what the valuation was at. Like I said, I'm trying not to poison my biases today, but I don't think it was overvalued yet, because I was kind of like thinking about when I might begin, what price I might begin to sell the stock at, but I definitely hadn't begun selling the stock yet. So I don't think it was overvalued yet. I just was considering it relative to other opportunities at that point. That was kind of the point I was getting to. I was like, well, the returns are no longer as amazing of an opportunity, but they were still good opportunity. So that was kind of where I remember my thoughts being last time I was actually considering the valuation and the price of Ingles, like maybe a couple weeks ago or something. So we'll see how much my actual valuation changes or not, and how much that changes the perspective on that. But either way, if you can project downward trend in the margins and downward trend in the sales capital, with a pretty relaxed and steady state amount of revenues, then and still end up with a good valuation, well, that's a pretty good valuation. Though it is also more of like a stalwart play or a cyclical play than it is a long-term qualitative holding, which means that you might want to take profits on it once profits are there. It's not necessarily something you want to hold forever. It's just a good value opportunity. But we'll see where I end up on that. But that's kind of my feelings towards Ingles. It's not one where I'm like, no, if I sell it now, I'm going to be missing out on the next few years of excellent value. And it's like, well, not really. We were really just looking for a revaluation on this one, and that's kind of what we got. So we'll kind of make our decisions on that. Sometimes you just can't argue with getting such a lucky quick revaluation as we did with this one. It's not always that you buy in and buy in and buy into a stock and it just keeps going up and up and up and up the whole time. You don't necessarily always want that. Sometimes you want it to stay down for a while so you can keep accumulating, but this one just kind of kept moving up like a rocket, and I bought it as long as I could, and I stopped buying it once I decided that was kind of the point. And that was all I got. So like I said, it didn't become a very large position, but it just kept moving up and up and up and up. So at some point or another, you have to just say, okay, well, that was it. So yeah, with the 5-year trend, as we already talked about the margins, you can see that. Looking back down at the sales capital ratio 5-year trend, you can see it's been on a pretty solid movement upward. We had a little bit of a downtrend here for these few years, and then it's been spiking in the most recent years. But either way, it's been kind of hovering under 3. So we'll see what we think about that. And then also taking a look at the, I guess we can also look at the working capital, since we were already doing it before. So you can see the current assets have been growing even more consistently if we look at the 5-year trend, and then the current liabilities, sort of the same. As you can see, it came back now to sort of the same number that we had in the 3rd year as we have in the 5th year here. So with a little bit of a bump up in between. So it's sort of in the same ballpark there, but therefore that extends it out, which means the growth rate of this is even lower relative to this once you look at the 5-year trend. So that's good. And then the returns on invested capital, the upward trend is also continuing. So with the same also being seen in the returns on equity. So yeah, the balance sheet and income statement and cash flow metrics all look good, at least for those 5 years. Even though, yes, it is a really low margin for those first few years, but everything else still checks out very well. It's just a low margin business, so it's hard to punish them, especially for that. You just might say you don't want to own this type of business for that reason. So they took a loss on the disposal in that particular year. Interesting. Yeah, see, so over this period of time, it's really just been 5 to 6% CAGR over the period of revenues, but during that time frame, they've quintupled their reported profit. So that I would say the disposals of unprofitable businesses or unprofitable stores has been extraordinarily successful. And then obviously that's boosted partially by the current standing of the COVID situation. But even if you're looking at 2019, that's still almost doubling of your profit when you had not moved your revenues that much, you know? So it'd been only like 3 to 4% during that period. So even so, prior to COVID, they were already doing a really, really good job of compounding. Oh, whoops, I'm in the wrong column here. I also do like that they're not really growing their deferred income taxes too much. The deferred income taxes can kind of be a positive, but they can also be a negative. Really, you have to go into their notes and delineate between the different subcategories of like how that's being expensed and what types of things are actually there, because some parts of that are things that they really just might have to have higher taxes later in the future, and then other parts of it are just accounting plugs based off of the differential between fiscal taxes or fiscal adjusted net income versus adjusted net income for accounting profit purposes. So some of those differences can be sustained forever, essentially, and that's just, whoops, then they're just going to be that way forever. And then other parts of it are things where they're just getting benefits up front and then might have to pay those things down later. So sometimes I'm really skeptical of really large growing balances in the deferred income taxes, while other times it's technically totally fine and totally a positive. But without having to look into it further, I try to be a little skeptical of those things. And I mean, that works mostly just for ongoing profitability. If you're thinking about for balance sheet purposes, you can basically just ignore it for the most part. That's mostly just a concern for ongoing operations, not for liquidation. But either way, the fact that they've had all this growing profitability and that particular line item is basically not really moving at all is kind of cool. I like that. It means whether that's good or positive, I don't really have to be concerned about it, I guess. So you could argue that if there were positive benefits to be had, that would mean they're leaving them on the table. So I guess that's the other side of that argument. Okay. 2 more years ago. Final real stretch. Oh, here, actually, hold on. Let's add some more columns over here to make it easier on ourselves. Cost of goods. Operating expenses, netting out gains from sale. Interest expense. Other income. Was there a loss on extinguishment that I missed there? We'll count that as an interest expense. Income tax expense. That leaves us with 21 million net profit approximately. Depreciation. Loss and gain and sale of assets. Sum and change of net working capital. Netted capex. And financing. Short term and long term. And extinguishment. Then treasury return to shareholders as well as dividend. And the balance sheet. Cash. Receivables. Inventories. Other current. Property, plant, equipment. And other non-current. Then the liabilities. Current debt. Amounts payable. Accrued expenses. Long-term debt. Deferred income taxes. And other non-current liabilities. Then to equity, common stock, A and B, paid in capital, retained earnings, and there's that. Now we move on to the last year. Revenue, cost of goods sold, operating expenses, netting, interest expense. Oh, was there an extinguishment I forgot? No, apparently not. Other income, income taxes, leaving us with 43 million profit. Depreciation, sale of assets, sum of net working capital change, net capex, Net financing, short and long term. Capital return to shareholders, repurchases and dividends. And then the final balance sheet. Cash, receivables, inventories, other current, property, plant, and equipment, other non-current, current debt, accounts payable, accrued expenses, long-term debt, deferred income taxes, other liabilities, common stock A and B, paid in capital, retained earnings, and that's it. Final thoughts on just their total capital record. We can also see that their shareholder equity has basically doubled over the 10-year period, basically doubled over the 5-year period too, because it was pretty consistent there for a long while, as well as the retained earnings growing dramatically, basically in pace with that same kind of growth as they shifted the paid-in capital from the B class shares over, and it's all been retained rather well, and that's while paying out the dividends. So there is that. They've been retaining their capital really well, which sets them up to possibly do large amounts of share repurchases at some point in the future. Again, that's also growing their cash levels, improving the working capital position, dramatically improving their returns on invested capital. How much of that will be sustained for the long run, it's hard to say. In fact, because it's like looking at the measures, it's probably better that we use more of a long-term measure for them, which drops their returns on invested capital more to like 10%, which gives them still excess returns, but it's just something that you probably want to do, is to not overestimate how much we're counting the excess returns that they've had in the most recent years as being a sustainable return on invested capital. We'll see how that looks in the long run moving forward though. Still haven't shifted over all the way, partially because I didn't want to taint the view. Don't get hung up on that. It is based off of some really large margins put in right over here, so that's definitely not accurate at all. Well, I guess we'll try to drop it into reasonable range. Obviously, as you see, like the worst year they had in their the record was the 0.57% year, and that wasn't. So, like I said before, I'm pretty sure I had a pretty low net margin as a basin in my previous valuations. We'll make decisions about where the top line is. It's definitely not going to be at 15%. As you see, their best year that they've ever had in this time frame is in the most recent year with their 5% measure. So 5% being a cap is probably pretty reasonable, and obviously that dramatically drops them back down. But that's because we still have a lot of other things to adjust. This is probably too high of a revenue range to expect for them, to be honest. Not really sure where we might want to put it, but like -2 to -5, so something like half the range of what we were just looking at makes a little bit more sense in my mind, but there's still lots of other things to look at as well. Debt to equity ratio and sales to capital ratio. Sales to capital ratio we have put down is set at basically a level of 1, and as we've seen already, they have a pretty significant sales to capital ratio. Now, when we were looking at a lot of other measures, we were kind of using longer term averages. It probably makes sense to do the same generally across the board, though not entirely. So like in the margins might stay elevated for the more recent couple years, so maybe it doesn't make sense to use quite as long of one for that. So we can use maybe the 5-year average, which puts it closer to 3% for the remaining near years, which basically suggests that if it's going to drop towards these basin values, that these are the points where it would start at as it starts to drop towards that. So I think that makes a little bit more sense, the idea that next year is going to be less profitable but not super unprofitable. In fact, you could even make the argument that it should maybe start more with a 3-year average, because then it puts it a little bit closer and then just drifts down towards those next more recent or less profitable years. Maybe. We'll take a look at this. Oh, we still have the 10% one here. But there's lots of other things to look at, so don't get too hung up on that. Like I said, sales to capital ratio, we haven't even bothered looking at. The most recent 3 years had a little over 3 as the average over a longer time frame. 5 years we get 3. Over a range of 9 years you get 2.94, which I think makes a little bit more sense in terms of things. If you look at like the averages prior to COVID, 2.94 I think makes a little bit more sense. Plus they have very high excess sales this year relative to their capital, though if they're going to want to capitalize on those excess sales in the years that follow, they'll probably likely also have to raise their total capital levels. And you could argue that even if it's not because of competitive reasons, if it's because of inflationary reasons, because the sales aren't adjusting for inflation, well, then the capital base is also going to have to adjust for inflation in the years moving forward with inflated dollars on the capital expenditures. Granted, they have a really low capital intensive business, so they're in a better position as far as dealing with those issues than the average scenario. Maybe the 5-year average makes a little bit more sense, closer to 3. So we can probably use that as basin. As far as what we want to make our ranges go for, maybe half that is generally a thought I kind of go for a lot of times. Now, as far as the top range goes, the top range really doesn't go that much higher than where we're currently at. As far as their historic record goes, 3.14 being the highest one. Generally speaking, I kind of use like 50% above as kind of like a baseline marker, which would be 4.5, but that seems a little bit large considering they've never been that high up. So if you shift it up to 4, that puts 2.75 is kind of the median value, with 2.49 is kind of like the average value, which means the average value drifts down towards the lower end of the range, which in my mind makes a lot of sense. You could argue this is still too high. If you just try to be extra conservative and use like 3.5 as the top range, putting 2.5 as the median, to 2.28 as the average, you say, well, that's just extraordinarily too low. I mean, we can shift these things around to try to make a compromise between those positions, so we can still have a higher basin that's not a high point that's not so high that it makes no sense relative to the current values, but also a lower basin that's still pretty conservative. And we never adjusted this. That's part of the reason that that number didn't look so agreeable. We were looking at the average. So like this is an average of 2.5. If you argue 2.5 is too low relative to where they've been in the past, so 2.75 because it's an average of 2.54. I don't know, I'm pretty satisfied with that number, but see how that dramatically improved the situation after we had adjusted the margin situation, which you could argue still requires further adjustment. There's lots of other things we still need to play with. I'm not necessarily super settled on the revenue situation. If you look at their historic record, obviously prior to COVID, they had 5-year CAGRs had been kind of sitting in this like 1 to 2% range. So these particular years are really throwing off the averages because we have really high revenue growth in those particular years. And so if you just assume that that's not where it's going to go, is that this is going to go back to sort of this range, that's basically where I want to put the midpoint, which the midpoint is here, but the average is not. Granted, I did not adjust the middle point again, so Jesus. So with 1% is kind of like the median point, with 1.15 is the average. That's actually a little bit lower than this point here, which could argue that maybe they'd had a revenue pull forward in these most recent years, so it should be a little bit lower moving forward. I would generally want to put it even lower than that, which you could do by maybe making this thing a 3%. But again, these are not inflation adjusted values. So if we're going to have a higher level of inflation, it could make the nominal values higher. And incidentally, by lowering the range there, may have noticed that it actually increased the value a little bit because of the dynamics between the margins and the sales and capital ratio. So this is a range I'm okay with. You could argue that maybe it should go down to here, and then we'll take a look at what the analysts actually are saying before we finish. I'm just kind of putting some numbers in here. Now there's a few other things still to adjust for, which is the debt to equity ratio. We kind of have projected for a 46.25%, which the current level is 44.67%. So again, that was higher than actually I was estimating, but now that I'm kind of doing the math in my head, my estimate before saying like 25 to 30% was definitely way off. Now as far as assuming where their debt levels would go moving forward, well, you could assume maybe they take a large dive in their market cap, and then that would bring their and while also issuing new debt, so that could actually bring their debt to equity ratios up near 100%. That's actually reasonably believable, like 90 to 100% I could see. So maybe like putting this down at 90 a little bit, because I'm probably going to raise this level up here, because I don't really see them going down to 0%, but I could see them dropping the ratio pretty dramatically. And then as far as like a midpoint for where the analyst would project, it has been trending downward, so I can see generally a downward trend being a good position for that. Let's see. And the margins, now that we've kind of played with some of the other numbers, I do want to readjust the margins, because I do want to, like I said, it's very uncomfortable to leave the margins even at this kind of level, just relative to where they were prior to the pandemic. It's like you look at their longer term average, there was 1.47%. If you just look at the most recent 5 years prior to that, it was 1.73%. The 3 years, 1.89%. So it had been improving prior to COVID, but it was improving at a very slow rate, and it was still staying at this like sub 2% level for any particular 3 year average. So even projecting to an expected level of 2.79 with a high point of 5% feels pretty incredible. It's one of the reasons why I'm willing to guide even lower on the margin level, just to be extra safe, and that brings the expected margin down to 2.26%. And this is again on adjusting the probabilities, because we might be willing to play with some of those a little bit as well. Now let's think about a few other things that we haven't looked at. The tax rate looks reasonable. You could argue to go a little bit higher, but the way this is affecting the margin, it doesn't actually go into the margin here. We adjust the margin independent of the tax rate, and we have to kind of take into account what tax rate we're thinking about when we're playing with the margin. This tax rate is primarily for calculating the weighted average cost of capital and the tax benefit from interest. So increasing it actually raises the value. So I don't necessarily feel the need to adjust that, even though 17%, it could be a little bit higher than that. And this same thing is to be argued sort of for the cost of debt listed here. It's arguable that instead we should use the listed debt, which would lower the interest rate and also probably lower the value. Well, actually, okay, so that actually raise the value. It depends because of the way it affects the formula for the market value of debt. So a lot of times it lowers value, but not always. I was kind of making an assumption there. So if that's the case, we'll go with the more conservative output and leave the higher interest rate in there, which will lower the value actually in another way too, because normally it's a balancing act between how that may or may not lower the value, and then also the interest coverage ratios, because that actually is projected from that number. So let's see what else, what other pieces might I be willing to adjust. As I'm not gonna lie, I wasn't necessarily expecting the value to be raised this much, so I want to make sure I'm not thinking too unreasonably here. Okay, might be about ready to go look at the analyst numbers. What's the 5-year average for this? Maybe it makes more sense to sit on the 5-year average for that. It's not really anything that adjusts for the current valuation, but it does help to when thinking about the metrics. Okay. Alright, so the only thing left I think I want to adjust is basically just the probabilities, and then maybe a little bit of adjustment of the analyst numbers. We'll go take a look at what they have to say. I can't remember how much coverage there was or was not. Oh yeah, one analyst is covering for revenue. They're projecting a negative 8%, 8.6% in revenue this next year, and then 3% growth in the year after that. So yeah, you kind of see, I mean, other people are definitely seeing this as perhaps a pull forward as well. If we just take that 8.6% and then multiply that by 1.03, and then multiply that by 1.015 to the third to give it a steady state after that, that gets you to 0.984, which if you compound back for 5 years, essentially says that you would be growing at negative 0.3% per year in revenue. So that's what the analysts are actually projecting, is negative growth ever so slightly. So we could just drop this to 0, but it actually probably increases the value. Yeah. So maybe 4% is too high on a best case scenario. Doesn't, like I said, because of the dynamics of the valuation, it doesn't shift, the revenue isn't necessarily what shifts the value that much. So there is that. It's like it doesn't necessarily mean that whoops. It doesn't necessarily mean that it's going to shift the value a lot. A lot of the valuation has more to do with the sales to capital ratio and the margin. Okay, that really didn't shift much, but I kind of like it regardless. I'm willing to assume that they do have positive sales growth, but ever so slightly. So if they're assuming negative sales growth ever so slightly, I'm willing to assume maybe slightly positive, because I do think there was a large pull forward, but I don't think they're really necessarily going to have a drop in their sales next year as a result of that. People are still going to need to buy a lot of the same stuff because a lot of their business model is based off of necessities, not stuff that gets pulled forward in large part, like that type of goods. This is more like the immediate goods. So they might have less growth, but they never really had much in the way of declines in major. So the idea of assuming that they're going to have an 8% drop in sales because they had a growth in 8% of sales this year doesn't make sense to me. They just might have 0% growth or even negative 1 or 2%, I imagine. So I personally feel like that negative 8% is like way overblowing it personally. And then they do have, let's see, EPS growth expectations of 14.5%, which that's not really going to play into the numbers in any way that really makes sense if you ask me, because that seems like you practically have to assume some pretty high margins on that. So it's like, are they really gonna have that high of margins after dropping in the sales? Maybe they really do believe in the whole shrink and become a super profitable thing, but to me that just doesn't make any sense. So I'm just gonna leave that number there. So yeah, I mean, that's pretty much, I think, all I want to do with them. I don't really want to shift too much else around. I think that's basically it. We'll adjust the defaults, and then we'll call it there. So they basically had no default risk in the most recent year, and they don't really have substantial default risk on the face of it, but they don't have a great interest coverage ratio for certain of their situations, which is going to lower their valuation to a certain degree, which is one of the reasons why lowering their debt levels is actually pretty advantageous to them. On that note, I guess we'll double check the debt equity ratio a little bit, yeah, because it is saying that it's still going to trend upward, which is perhaps a little unreasonable. Maybe 80% would have been a better baseline. Where's that bring it to? The 43, so that's technically a drop. It's not as much as I would like. Maybe 5% is the... Okay, that's maybe a little bit better. Didn't really change the valuation that much, but it will change the these default risks dynamics a little bit, which will change the overall valuation a bit. All right. Okay, so I guess that's gonna do it. Oop. Let's have an issue. All right. All right, so that's gonna do it for this one. Ticker IMKTA, Ingles Markets. As I said, largely family-owned and operated business, though that's slowly been changing and it's been shifting more towards a shareholder-owned base, which as that capital structure changes, it kind of becomes much more lucrative for the equity shareholder, as well as they've been paying down their debt. So overall, this is kind of a capital structure workout kind of play, as well as a stalwart valuation. It's like just these particular reasons have been depressing the valuation for quite some time, and so it's a pretty good way to get a consistent and dependable valuation return over time through that method. Like I said, I was already kind of considering whether or not to capture those returns because it had already moved up pretty significantly since we had taken our position in it several months ago. But we were curious to see where the valuation would go after adjusting today. Definitely has increased a little bit. Nothing crazily, I don't think. Let me pull up in the other valuation now and see what I actually had down for it. Just kind of briefly look at all the assumptions I had put in place here. Interesting. Okay, yeah, so I mean my valuation said that the price they would have been worth today is $82.39 last year, with a forward value of 110.63. So I have $100 here, so that's like 20-some% higher, as well as $134 here. So definite improvement on the overall valuation. As far as the changes in my assumptions, it turns out I have exactly the same set of assumptions here and here. Not quite true. Here I have 2.5% for the analyst model as opposed to 2% on the previous year. So which like I said, I think those are the major components of the valuation. And then the sales projection, I have here -2 is the base with 3 is the top, and 0 is the analyst. I have -4 is the base, and on the other one with -5 is the top, or with 5 is the top, and 1.5 is the analyst number. So here it's a 0.43 on expected, and it's 0.76 on the previous one. So by lowering the expected sales growth, that's one of the factors that seems to be at play here, as well as I significantly lowered the expected debt to equity ratio. Apparently I had projected pretty high debt to equity growth. I apparently didn't have a high confidence in them paying down their debt for some reason when I was doing the valuation, or I was just being overly conservative on that front. But by putting that, I think, into a little bit more realistic perspective, that's, I think, one of the factors that changes it too, because that would lower their the discount rate across those particular years and setups, which is interesting because the discount rate I have listed here is actually higher than the one I have listed over here on the face of it. So on the face of their business mix and stuff, it looks like their discount rate actually went up, but the way it plays itself out over the course of the several years is probably better because of the shift in the forward expectations of debt to equity ratio. So either way, this is it. IMKTA, Ingles Markets Incorporated. The U.S. Treasury today is selling for 1.44%. Equity risk premium in mature markets is 4.97%. I come to a discount rate of 6.12% for this company after adjusting for idiosyncratic and business segmented risk. And then they have a dividend currently of 0.84%. They had sales 5 years ago, $3.7 billion, and in the most recent year, $4.9 billion, giving them a sales growth of 5.62% per year for the last 5 years. They have a sales capital ratio for the last 5-year average, I believe it was, of 3, compared to an industrial expectation for them of 4.06. So lower than their industrial expectations, but it's a pretty high sales it's a capital ratio expectation regardless. And then they had returns on invested capital for the most recent 5 years, or was it 3 years that we used for that average? I can't remember. 11.88%, and they had debt to equity ratio currently of 44.67%. Basically, a pretty negligible amount of default risk. And then their profit margins for the last 3 years on average has been 3.61%, which is compared to their industrial expectations of 4.29%. So they do have lower sales capital ratio and profit margin than their industrial expectations in both categories, but it seems like the valuation works out pretty well for them overall, regardless of that. What would generally be considered a low qualitative effect by the way we like to look at valuations. Either way, so they have profit in the most recent year of $250 million, and they're selling on a current price of $78.36 per share. And probability distribution we use for them is mostly normal, with a little bit more extra weight tilted into the median model, which we have sales projections for them of anywhere from $4.5 billion to $5.7 billion, with an expected value of $5.1 billion, which gets them sales growth of anywhere from -2% per year for the next 5 years to possibly +3% per year for the next 5 years, with an expected value of 0.43%. We have expected sales capital ratio for them of 2.54, which gets them a lower return on invested capital down to 6.66%, which is definitely a drop compared to where they were in the most recent years, but they have an elevated returns on invested capital currently because of mostly, I think, just the current market dynamics, and I think that will level itself out over time. We have debt to equity expectations for them of around 41.38%, which is a small drop from their current levels. We do think that overall they will have a little bit of more significant default risk in the 5-year forward period of around 1.49% per year, relative to their overall debt levels, but that's not a crazy amount of debt risk, so no real concerns there. We do overall believe that their profit margins are likely to drop on an expected basis down to about 2.18%, just because they've had much lower margins in the past, and we do think that the current market dynamics are just giving them elevated margins that will eventually start to dissipate. Overall, we have profit expectations for them pretty wide across the board, of anywhere from a worst case scenario of $11 million of profit to possibly $231 million of profit in the best case scenario in the 5-year forward period. But again, that's largely based off of some pretty conservative expectations, I think. So it could be significantly higher than that depending on circumstances. Overall, we come up to a present value based off of the discount rate that we're using for them of $100.01 per share, which is 27 to 28% higher than the current share price. We have 5-year forward value targets unadjusted for the dividends that they'll pay out during the period of anywhere from $17.29 per share to possibly a high end of $350.82 per share, with an expected value of $134.56 per share, which compared to the price it's currently selling at means that we have an implied 5-year forward return of 11.42% per year for the next 5 years, which is pretty significant, pretty decent. Not the most amazing qualitative factors, but pretty decent overall, which combined with the pretty high absolute returns gets us a valuation score of 1.09, which is my personally defined valuation metric for comparing relative opportunities in the market. So I consider that to be a pretty decent score, though not an amazing score worth necessarily purchasing a whole lot more at or something, but definitely not necessarily worth selling at either. So there's that. The short-term pricing metrics based off of current multiple regression is not really functional because I'm not getting some of the inputs in from the analyst data, so we can basically just ignore this down here. So yeah, that's gonna do it for us today. That's Ingles Markets. Like I said at the start of the stream, I was kind of curious to see whether or not I would be determining if this was worth at a worthwhile selling point now, but I guess maybe not. I guess it's worth holding on to for at least a little bit longer, into next year perhaps. So I don't know, but that's not an absolute decision because, like I said, I have to make relative decisions based off of alternative opportunities and then other things along those lines. But it's a definite improvement in Ingles' relative position as far as alternate approaches. As you can see here in my watch list, I have the valuation score that the old valuation for Ingles had, which was 0.78. So just as a relative basis, the old Ingles valuation that I was relying on yesterday said that they were worth 0.78 as far as my personal valuation score, and now it says they're worth 1.09. So that's like a 30% increase in relative worthwhile of an investment on the criteria that I've designated anyway. So just as you can see, kind of a look into my own way of valuing companies relative to each other. That's me value one company relative to its valuation that I had last year. So that's going to do it for us today. We stream 2 times a week, Monday and Friday, around the time the market closes, though we started a little bit late today. I'm not 100% sure what we're going to be doing on Monday. Waiting for a few other 10Ks to kind of come in. We finished the Ingles one. I am kind of waiting for what was the next one I was looking at. HP is likely going to be coming somewhat soon, but probably not by Monday, so that's not necessarily one that'll be doing. It might be a new company or off of one of the other lists of interesting models that I had put together a week or two ago. I'll have to decide that over the weekend, but either way, that's going to do it for us today. I will catch you all next time.